They're not warning you about a recession, they're warning you about a new financial empire. Because right now the world is watching a market that looks unstoppable, while the real economy underneath it is quietly weakening. And that contradiction is the most dangerous thing in finance. Your sample describes an unprecedented disconnect between market valuations and real economic health, where prices no longer reflect production or real profit, but crowd emotion fueled by financial dopamine. Here's the paradox. The market looks strongest exactly when it becomes the most fragile. The market cap to GDP ratio in the US has crossed 200%, a level described as the thinnest ice in history. And the warning is cold. Above 100% bubbles form, above 150% cracks appear, and at 200% the system enters its most brittle phase. Now watch how fast this escalates. The CAPE ratio implies US stocks are priced around 110% above the historical average, meaning investors are paying roughly double for the same value. It's like spending 100 million to buy something worth 50 million. And when pricing becomes belief, the danger isn't a dip, the danger is a snap. If you think this is just about your portfolio, you're missing the real risk. Because the moment confidence breaks, it doesn't stay inside Wall Street. It hits debt, currency, borrowing costs, and the price of normal life. But here's the part nobody is saying out loud. The market isn't rising because it's healthy. It's rising because the system has been trained to expect rescue. And if that rescue fails, everything flips. The United States is trapped in a public debt spiral with total public debt above $37 trillion, and it's no longer abstract. The US now spends more than $1.2 trillion a year just to pay interest, more than defense, and over half of federal revenue. This isn't a budget debate, it's a structural countdown, because the most expensive illusion in history doesn't end with a warning, it ends with a trigger. And that trigger may already be forming. To pay interest on old debt, America must borrow new debt and print more money, but when rates stay high to fight inflation, the interest bill swells even faster. It's like a household earning 10 million but borrowing 20 million just to maintain lifestyle, then sinking deeper to service past debt. Real GDP growth around 4% can't keep up with debt growth of 8-10%. The productive base can't catch up with the financial burden. This is where the story flips. Because once the world senses that, lenders don't panic politely. They demand yield, they demand control, they demand exit plans. The question isn't whether America can pay forever. The question is how long the world keeps financing it like it's risk-free. And here's the deeper layer. The US has had one brutal advantage that made this possible: the ability to export its own inflation outward. When America prints money, it doesn't eat the full pain immediately. The excess flows into the global system through trade deficits and foreign reserves. The mechanism lets the US trade paper for real goods, real labor, real resources, while diluting the value of anyone holding dollars. That's invisible taxation on the world. But now it's turning into a blade that cuts both ways. Inflation in the US peaked around 8% in 22, the highest in 40 years, forcing the Fed to raise rates and tighten. And this is the trap. Higher rates are supposed to crush inflation, but higher rates also crush the debt structure. So now the system faces two ugly doors: pay higher yields to keep borrowing, or weaken the currency to make the debt smaller in real terms. And the moment devaluation becomes a survival tool, the dollar stops being neutral money. It becomes political paper. This is where history stops being a lesson and becomes a warning. The dollar's dominance was engineered. Bretton Woods in 1944 pegged the dollar to gold, turning America into the world's gold bank. Then in 1971, the gold standard ended. The dollar became fiat, built on trust. To keep that trust alive, America built the Petrodollar system. Energy trade ran through the dollar. That created forced global demand. But no reserve currency holds power forever. The British pound once ruled the world, then declined after World War II through exhaustion and loss of production power. And the same pattern is now forming again. America is no longer the main production engine. Manufacturing and real capacity have shifted east. And when the productive base moves, money dominance becomes unstable. But here's the part nobody is saying out loud. The fastest way to accelerate a replacement is to weaponize the system you depend on. And that is exactly what happened. In 2022, the US froze more than $300 billion in Russia's foreign reserves. That wasn't just punishment, it was a precedent. It told the world, your assets are not safe if you don't follow Washington's rules. And the world heard it. Holding dollars, holding treasuries, holding reserves suddenly didn't feel risk-free. That shock triggered a wave of de-dollarization because countries realized the reserve system had a kill switch. China reduced its treasury holdings from over $1.3 trillion to around $770 billion, the lowest level in 15 years. Now notice what they didn't deny. Nobody denied the dollar still runs the system today, but they began building exits while the lights are still on. Alternatives to SWIFT started gaining momentum, like China's CPS and Russia's SPFS, designed to avoid US control. That's how an empire loses monopoly, not through one dramatic rebellion, but through 1,000 quiet bypasses. And those bypasses now have structure. BRICS is no longer just Brazil, Russia, India, China, South Africa. It's expanding, pulling in Saudi Arabia, Iran, the UAE. This bloc accounts for more than 40% of global output by purchasing power, surpassing the G7. But here's the part nobody is saying out loud. They don't need the dollar as long as they control the inputs of the modern world. Energy, manufacturing, labor, raw materials. BRICS controls critical resources, energy from Russia, Saudi Arabia, Iran, labor and production from China and India, commodities from Brazil and parts of Africa. So when these countries begin trading oil and goods in yuan, ruble, or a gold-backed unit, global demand for dollars starts falling, and once demand falls, the dollar's automatic dominance becomes optional. Now watch the mini-crisis stack. This is where the speed changes. Central banks have been buying gold at a record pace, over 1,000 tons per year for 4 consecutive years, led by China and Russia. Gold is neutral. It can't be printed. It can't be frozen by sanctions. That's not speculation, that's preparation. Because the moment gold becomes the anchor again, paper currencies start looking like promises with expiration dates. And there's a darker scenario being discussed too. A shock repricing of gold to $10,000 to $20,000 an ounce to reset balance sheets and erase debt. Whether that exact number happens or not, the behavior tells you the fear is real, and it's not just governments moving, it's the private sector. Chinese giants like Tencent and Baidu have shifted away from borrowing in dollars and into issuing yuan-denominated panda bonds. Offshore RMB bond issuance nearly tripled from 2021 to 24, reaching close to $200 billion. The logic is simple. Capital in yuan is cheaper, around 2.1% versus 4-5% in USD, and there's long-term expectation of RMB strength. This is not symbolic, it's structural positioning, because once corporations stop needing dollars to fund growth, de-dollarization doesn't happen with speeches. It happens with contracts. Now we shift to you, because this is where the story stops being global and starts being personal. You don't experience a reserve shift as a headline. You experience it as friction. Borrowing gets more expensive, prices don't come down, wages stop winning, the sense of normal stability quietly disappears, one bill at a time. And this isn't just happening overseas. Inside the US, at least 7 states have passed laws recognizing gold and silver as legal tender. That is not a hobby. That's a local survival reflex. Because when people stop trusting the central machine, they start building smaller machines. And once that starts, it accelerates. Washington is locked in political deadlock. Debt ceiling fights become power games. the risk of shutdowns and technical default episodes grows. And every time that happens, lenders around the world ask the same question. Does the US still have the internal stability to manage the system it created? Now here's the systemic mechanism most mainstream coverage can't explain cleanly. The dollar survives on forced demand, and the strongest engine of forced demand is oil. The petrodollar system kept America dominant for 50 years by creating compulsory dollar demand and recycling surplus into US treasuries. But that pillar is cracking. Saudi Arabia, the cornerstone of the petrodollar system, has publicly negotiated oil sales in yuan and joined BRICS alignment. That signals something historic. Oil no longer needs the dollar as the default language. And the moment oil stops requiring USD, the dollar stops being the mandatory gatekeeper. This is where the story flips for the last time. Without that forced recycling flow, America has to pay for trust instead of assuming it. That means higher yields to attract debt buyers. Higher yields worsen the fiscal strain. Fiscal strain pushes more printing. More printing worsens inflation. And inflation fractures trust even more. It becomes a loop. Now the near future trajectory is simple. Two paths. No easy endings. Path one is a slow bleed. The dollar remains important, but not exclusive. More trade settles outside USD, borrowing costs rise, fiscal pressure grows. Path two is a reset. A crisis is allowed to burn through the old structure, then the rules get rewritten through deliberate inflation, potential gold revaluation, and a shift towards central bank digital currencies. CBDCs are the control layer. Total tracking, direct taxation, negative rates, cash elimination. And in that transition, paper wealth becomes the easiest thing to reprice. This is why the biggest danger isn't the crash, it's the redesign. So here's the deep insight that reframes everything. A reserve currency doesn't die when people stop using it. It dies when people stop trusting the rules behind it. And right now, trust is being replaced quietly by new rails, new assets, and new alliances. Value doesn't disappear, it moves. This becomes the great transfer where wealth shifts from people holding paper assumptions to people holding real scarcity. So don't ask, will the dollar collapse tomorrow? Ask the smarter question, who is positioned for the new system before the old one admits it's over? If you want the next layer, what the transfer looks like, who wins, who gets trapped, and how the rule change shows up in everyday life, subscribe, because the biggest story isn't what breaks, it's what replaces it.